What's up, everybody? Welcome back. As always, my name is Shawn King, and today I've got another fantastic video for you. We're going to get deep into the weeds. We're going to look at some numbers. I'm going to pull up my own personal illustration, and we're going to go over some of the details of what you might see when you start the infinite banking process, when you become your own banker. So what we're going to do is we're going to jump into some illustrations. Again, I'm going to use one of my newest personal policies and go over some of this stuff with you guys, but I really want you to get a peek behind the curtain. I want you to see some of the numbers because I'm a very visual person. When I'm able to see things, they make a whole lot more sense for me. So today I just wanted to break some stuff down for you, go into a couple of the different terminology things, and really show you how amazing these policies can be when they're utilized correctly and when you start to become the bank. So let's go ahead and jump right into it and buckle up because it's going to be a good one. I want to start off by talking to you guys about the cash flow analysis that we do for our clients. This basically just gives them a breakdown of their policy so we have something to compare as they progress through their banking journey. I'm going to say this multiple times, but what you're going to see on the cash flow analysis is going to be a bit more conservative compared to the numbers on your original illustration. So if we look at the annual premium column, the first 20 years, I put in a total of $350,000. If you take a look at the next illustration here, 6 months in, I've added an additional $38,300 to that first year's premium. Now again, these are conservative numbers here in the green column, and I'll show you what I mean when I pull up my actual illustration. But essentially, we're under promising and over delivering. So as you can see here, the difference between what they're showing on the illustration in the guaranteed cash value column and what I'm showing on this cash flow analysis is about $324 difference. Again, not something to focus on, because if we tell you things are going to work out like this and they actually work out better, you're definitely going to be happy. So the next column I want to address is the projected dividend. Now, the original total at the end of year 20 is $56,861. Understand, this is not where the policy ends. I'm just showing you this 20-year period. Anyways, $56,861 total for my projected dividend over that past 20 years. But on the other page, with my injection of $38,300, the estimated dividend has now increased to a total of $73,292 at the end of that 20-year period. That's a $16,431 increase in my dividend just by putting that extra cash in. Now, if we look at the projected cash value per year column here in the green, those numbers totaled $450,029 at the end of 20 years in my original illustration. But after that $38,300 injection over the first 6 months of my policy, the new numbers total $518,496. That's a $68,467 difference. If we were to take that $38,300 I added to the policy and subtract it from the $68,467 difference, that means we'd be left with $30,167. So just by injecting that additional $38,300 in the first 6 months of my policy, it ended up earning me an additional $30,167 over the next 20 years. Now, some of you might not think that's a big deal. I urge you to take a second and understand that I just made myself an additional $30,000 over the next 20 years of my life by simply putting money I was already going to put into someone else's bank into my own personal banking system instead. That money had to live somewhere, right? And remember, this was just over a 6-month period. Imagine what this looks like if I kept adding additional funds over the next 3 to 5 years. Heck, maybe 5 to 10 years if the policy allows it. I can't even imagine what it would end up looking like, but I'm damn sure excited to find out, because you know that's exactly what I'm going to do. The last thing I want to touch on this page is the death benefit increase over that 20-year period. So originally, at the end of that 20 years, I would have had approximately about a $1.49 million death benefit that would pay out to my family tax-free if I passed away. But by adding that additional $38,300 in the first 6 months, my new death benefit at the end of that 20-year period has jumped to approximately $1.71 million. That's around a $220,000 increase. For you math people, that's an additional 574% return on that extra $38,000 I put in. Not too bad if you ask me. So the next thing that I want to touch on is the cash on cash return page. Now, I'll quickly explain how you calculate cash on cash return, so this will make a little bit more sense to you guys if you don't exactly know how to do that. Now, some people really like to focus on this, others don't really care much, but I want you to know the math behind it in case it's something that you might value. So if we take a look at year 5 in the total net cash value column, you see $110,173. Now what you're going to do is you're going to take that $110,173 and subtract it by the previous year total, so $84,904, and that gives you $25,269. You'll then take that $25,269 and subtract $25,000 from it, which is the amount of premium you paid in that year. That leaves you with $269, and the last step is divide that $269 by the amount of premium that you paid that year, which again was the $25,000. If you do that correctly, you'll end up with 0.01 or 1% after moving the decimal. Now remember, I said our illustration was conservative, which means we make this look slightly worse than it actually is. That's why instead of a 1% cash on cash gain, you see a negative 1.74% loss of liquidity. All that means is in year 5, when I put in my $25,000 premium, I'm going to have access to 98.26% of that money. Or in other terms, I'll have a loss of about 1.74% of my liquidity. So if you understand that no matter what business you're in, there's always a period of capitalization before you go from technically being in the red to in the black, or making money, however you best understand that. But remember, by using our policy and playing good banker, we can make all of this even more efficient, which I'll show you here in just a moment. So now you know how to do the math. Now, what I want to do is focus on the difference between what it was before and after I injected the additional $38,300 over that 6-month period. So we've established before the $38,000 injection, our cash on cash return was conservatively negative 0.174% in year 5. But with the $38,000 influx, it's now showing a positive 1.7% cash on cash return. Now you might not think that's a huge deal, but if we look down at the 20-year mark, all of this plays out pretty nicely over time. Our original illustration shows us a 142.99% cash on cash return that year, while our updated illustration with the influx of cash shows us a 175.96% cash on cash return. Those are crazy numbers. You're not getting that in the market. What that means though is by putting in that additional $38,300 in the first 6 months, come year 20, my policy will be producing about 33% more cash when I put my $10,000 annual premium in. Yes, I said 10,000, not 25,000, because the illustration shows the PUA rider no longer on the policy. So what I'm doing at this point is just paying the base premium. So instead of my $10,000 premium instantly turning into $24,299 in new available cash, it'll turn into $27,596, and that spread from the original amount will continue to increase every year due to that early compounding. So while I was looking over all of this before I put this video together, I did some quick math And by year 35, that 33% difference I just mentioned has now increased to about 76% difference, meaning that $10,000 premium is turning into 76% more cash than it was originally illustrated to before I put that net injection of cash into the policy. Think about how drastic of a change that is. And I accomplished all of that in a matter of 6 months, just by putting money I would have otherwise put into someone else's bank into my own personal system first. All right, guys, so my current illustration, which is worth the paper that it's printed on, actually says by year 20, it'll be a 205% increase, not a 175.96% increase like you see here. But again, under promise, over deliver. The last thing I want to touch on are 2 points some people really like to focus on. Again, I think if your focus is infinite banking, all of this stuff will just naturally happen for you and you won't particularly care when it does. But again, I want you to have the info so you can understand what's all going on. So the first thing that I want to mention is what we call the efficiency point in the policy. Basically, what that means is when I pay my premium for that year, so in this illustration, it's $25,000. So when I pay that $25,000 premium, what year does that $25,000 premium automatically turn into, at minimum, $25,000 of cash that I can access immediately? Essentially meaning that I moved it from one pocket, aka the third-party banking institution where it was normally held, into my own personal banking system with zero loss of liquidity. The cool thing about the efficiency point is, from that point on, every time you pay your premium, more money than you just put in will be available to use. And that number will get bigger and bigger every single year for the rest of your life. Some might liken that to a money printing machine. I don't know. You tell me. Anyways, my original policy's efficiency point was year 5, which is not bad. That's pretty normal, especially for someone around my age. But my new efficiency point after my $38K injection is now year 3. But remember, this policy is only 6 months old. So by the time the first year is over and I've injected even more of my income, it will without a doubt be at year 2. I mean, at the moment, it's less than $1,000 difference, but that means come year 2, when I put my 25K premium in, more than 25K will show up in my available cash value, not including the previous cash value from the past year. Hot damn. The last thing people like to look at, which again, doesn't matter at all to me, because all I'm really concerned about is controlling the banking function in my life, and you should be too. But the last point is the break-even point. All that means is at what point will I have access, meaning liquid cash value, to every single dollar I've paid into the policy thus far. Before the influx of cash, I would have broken even at year 10, which again is extremely normal. After the influx of cash, and taking into account the next 6 months of this policy, receiving even more cash before that year anniversary comes up, it will have jumped from year 10 to year 7, which again is a drastic change in 1 year. It's like cutting time off your mortgage. So just to recap, all I'm doing is funneling money I would have held somewhere else into my own personal banking system where I have full access to it. There's a small window of capitalization, which will be different for everyone, but the more you bank with your policy and pay yourself back with interest, the faster that you will reach the efficiency point and that break-even point. Remember, the money that we loan is not our money. Our money is being used to leverage some future death benefit that we get access to in the form of cash value. But that's not the point. The point is, I'm now in control of the system. I have the ability to take and repay loans on my own schedule. I'm no longer losing out on the interest I would have been paying to third parties because I finance my purchases through my own system and I recapture that once lost interest by paying it back to myself. In turn, giving myself essentially immediate access to those funds once again. And most importantly, I do as little business with the banks as possible, which means I'm not giving my money to them to loan out 10 times over. I'm not playing part in the system, continuously devaluing my dollar. I'm in control. And when you're in control, I think you'll quickly find out life is so much better and the opportunities to grow your wealth become essentially infinite. Hopefully this video provided some sort of value to someone out there. If it did, please feel free to share it with others. When it comes to personally practicing and teaching the infinite banking concept, I have nothing to hide. Like Nelson Nash would say, if you know what's going on, you'll know what to do. I just want to help as many people as I possibly can begin to understand what's going on, and then with that knowledge, put a plan in place so they can start taking back control of their lives. I highly suggest getting yourself a copy of this book, Becoming Your Own Banker. This is the Bible of infinite banking. This is really the workbook that you're going to find so many of the answers in and constantly refer back to. Please don't forget to subscribe to the channel, smash that like button, and check out some of the other extremely helpful videos I post on a weekly basis. If you'd like to chat about your own personal situation or how you can start the process of becoming your own banker, go ahead and click that Calendly link in the description below and let's hop on a quick call. I absolutely love talking about this stuff and helping people understand it better. As always, guys, the information is free, but the knowledge is priceless. My name is Shawn King, and I'll catch you next time.